Today we'll be talking about bonds. Imagine you lend money to a company. The company promises, give me 10 lakh rupees today and I will pay you interest every year and return your 10 lakh rupees after 5 years. Now that sounds simple, but now imagine doing this with a 60 lakh crore worth of corporate debt. Millions of transactions, thousands of companies, banks involved, insurance companies involved, mutual funds involved, foreign investors involved, depositories are there, clearing corporations are there, then custodians are there and regulators are there. And not just this, multiple layers of paperwork and reconciliation. Suddenly, lending money isn't so simple anymore. Now imagine replacing part of this infrastructure with a shared digital ledger, where ownership of a bond can be recorded digitally, where the transfer of the bond and the corresponding money can potentially happen simultaneously, and where even coupon payments could eventually be automated. Now this isn't any fiction. In August of 2026, SEBI, Security Exchange Board of India, announced plans for a pilot on bond tokenization. Yes, the word is correct, bond tokenization. Now, at almost the same time, SEBI made another seemingly unrelated change. Foreign portfolio investors FPI can now submit digitally signed powers of attorney, eliminating the need for notarization or consularization. Now, two reforms, but one idea. Make India's capital market of India, making it faster, simpler and accessible. But why does India need this? That's the question. And can blockchain actually solve the biggest problem facing India's bond market? Let's start with the basics and let's try to understand today. Now, let's address the elephant in the room. What exactly is a bond? Now, before understanding tokenization, we must first understand the product itself. Now, understand bond like this. Bond is essentially a loan which can be traded. In simple one line, it's a loan that can be traded. Now suppose XYZ company wants 100 crores of loan. Now instead of borrowing the entire loan from one bank, it can issue a piece of paper, right? And in that piece of paper, it can write that, okay, the amount of this piece of one paper is 1 lakh rupees. And I am issuing this piece of paper for the public to purchase. Now if public purchases this piece of paper today, after 5 years, a person can come with that same piece of paper and can redeem the 1 lakh rupees he has given earlier, and for every year on that piece of paper the person would get an interest also. So what basically the company promises? Company promises regular interest, which is called the coupon, and a repayment of the principal at a maturity, which can be anything. It can be 5 years, it can be 10 years, it can be 20 years, right? And the investor meanwhile gets a financial asset that can potentially be sold before maturity. Basically, now if this XYZ company is there. Now this XYZ company is wanting loans, which is why they're issuing that pieces of paper, which we call as bonds. Now while they're issuing those pieces of paper to the public while they purchase those bonds, they can, even before the maturity, let's say the maturity period is 10 years. But what if the person who's having that piece of paper, what if that person wants money earlier? So basically what the person can do is, he or she can trade that piece of paper with some other person, which means these bonds are tradable. So that's the fundamental difference between a conventional loan and a marketable bond. A bond converts borrowing into a tradable financial security. The word is very important. A bond converts borrowing into a tradable financial security. And this matters enormously for an economy because companies needs long-term loan for a lot of things, for factories, for roads, for power plants, for housing, for telecom, for infrastructure, for expansion and so on. And banks cannot and should not finance everything as well. And a deep bond market allows us savings which are happening in the economy amongst the people to flow directly towards the borrowers, no intermediary in between. This is how bond market usually works. Now, India has traditionally been much more comfortable with bank-based financing than with the market-based debt financing, right? Bonds also we can call it as a debt financing. Debt means a loan, right? And bond is nothing but a tradable loan. Now think about India's financial system. You deposit money in a bank, right? A bank lends that money to a company. That is one route. But in a mature capital market, companies can also directly access investors through equity markets and bond markets. India's corporate bond market has grown significantly in the last few years. According to SEBI's latest data, outstanding bonds issued by financial and non-financial corporations stood at approximately 60.65 lakh crores as of July 2026. Now that's a massive market, 61.65 lakh crores. But size alone doesn't tell you the whole story. The question is, how efficiently can these bonds be issued? How efficiently they can be bought, they can be sold and settled? Because that's where India's bond market still has a room to develop, still has room to improve. Now imagine India wants to build highways or renewable energy projects or metro systems or ports or data centers or even semiconductor plants. These projects often require long-term capital, usually for 10 years or more. But banks generally have liabilities, such as deposits that can be withdrawn or repriced. A deeper bond market, on the other hand, creates another source of long-term finance for the country. And there's another advantage. It diversifies risk. Instead of banking system carrying almost all of the burden of corporate financing, risk can be distributed amongst mutual funds, amongst insurance companies, amongst pension funds, amongst banks, amongst foreign investors and individual investors. This is why policymakers have repeatedly tried to deepen India's corporate bond market. Now, since you've understood the word bond, right? Now, you need to understand two terms here. First of all, there's a bond. Now, this bond can be issued by the government also, can be issued by the private companies also. Once it's issued by the government, we call it as a government bond, or you must have heard of this term, government securities. But if it is issued by the companies, we use the term corporate bond over there. So while we are using the word corporate bond, it means the bonds issued by private companies, which means private companies, when they are raising money from the public in the form of loans, they'll issue a piece of paper which we call as a bond. It's a piece of paper which actually it's a contract. Now, the RBI has described India's bond market as one of the largest amongst emerging market economies in the world. Its annual report estimated the broader Indian bond market at around $1.2 trillion. $1.2 trillion, understand. Higher than a lot of countries' GDP also. But there is an irony. India has a large bond market for sure, yet liquidity and accessibility remains major challenges in our country. Now suppose you buy a corporate bond. You will receive interest on it. Everything looks fine. But suddenly you need your money before maturity. Let's say the maturity period is 10 years and you want to sell that bond. I told you bond is tradable. Now you discover there isn't any much trading happening in that particular bond. So you may have to accept a lower price of your bond if that bond is tradable, but the demand is not huge. This is called liquidity risk. Please understand. Liquidity risk means that when you have to trade your bond at a lower price than at what you bought it. And why would you sell it at a lower price? When you need money immediately and there is less demand of the bond which you are holding right now. This is what we call as liquidity risk. Now, a market can therefore be large but not necessarily deep. And this is one of the fundamental challenges of India's corporate bond market. SEBI's own stats shows enormous volume of transactions taking place, but also the complexity of the ecosystem through which these trades are settled. The complexities involved as well. In July 2026 alone, corporate bond trades are settled through clearing and other channels ran into thousands of crores every trading day. So the challenge isn't simply how do we create more bonds? It is how do we create a market where bonds can move efficiently between investors? And this is where now technology would enter and blockchain would enter. Now forget Bitcoin for a moment, because you must have heard blockchain with the term Bitcoin. Bitcoin is not synonymous with a cryptocurrency. Please understand this. Blockchain is a technology. At its simplest, a blockchain is a shared digital ledger where records are made. What is a ledger? Ledger is something where records are maintained. So it's a shared digital ledger. Imagine three people maintaining separate notebooks, recording who owns what. Every time something changes, they have to reconcile their notebooks. And that's very inefficient. Now imagine all three are looking at the same synchronized digital ledger. A transaction is recorded once. Everyone authorized to participate sees the same version, and that's broadly the intuition behind distributed ledger technology. And now imagine applying that idea to a bond. Instead of recording ownership through traditional systems alone, you create a digital token representing the bond or an interest in it. This is what we call as tokenization, where you create a digital token which represents the bond or the interest, and simply we call it as tokenization. The question is, what is a tokenized bond? Let's understand it with a very simple example. Now suppose that XYZ company was there. It was issuing 100 crore worth of bonds. Now traditionally, ownership exists through established security infrastructure. Now imagine the same economic interest is represented digitally on a blockchain based system. That a digital representation of the interest or the bond is token. The token can contain or link to information about ownership, about transfer, about coupon payments, about maturity and other contractual features of the bond. But remember, tokenization does not magically change the underlying economics. If the company promised 8% interest, tokenization doesn't make it 12%. If the company defaults, Blockchain doesn't make the company solvent. It's just that the bonds are now digitally taking place. The technology changes the plumbing, not the fundamental credit risk. That distinction is extremely important. Now let's try to understand what SEBI is actually trying to test. See, SEBI's proposed pilot is intended to examine whether distributed ledger technology can improve the functioning of the bond market or not. So if we introduce this blockchain into the bond market, will it improve the bond market or not? Simple. And one important concept is delivery versus payment, or D versus P. Let's simplify it. Normally there are two things happening. Bond moves from seller to the buyer and money moves from buyer to the seller. The risk is that these processes may not occur at exactly the same moment. So D versus P, DVP, attempts to ensure the security moves if and when the payment happens. A tokenized infrastructure could potentially bring these processes closer together, even allowing a near simultaneous settlement. And SEBI's pilot is also expected to examine possibilities such as automated coupon payments and smart contracts as well. Now, a smart contract is essentially a computer code that automatically executes predefined conditions. For example, on this date, pay the coupon to every eligible bondholder. Simple. No manual reconciliation, no separate instruction for every investor. At least that's the theoretical promise under what RBI is trying to do, or under what SEBI is actually trying to do, not RBI. Now, this is it. Now, please understand, this is not India's first attempt to digitize its securities. In fact, the transformation began decades ago in 1988. In 1988, SEBI was established as a non-statutory body. In 1992, SEBI received statutory status through the SEBI Act. This came after the security market scandals that highlighted the need for stronger regulation. But then in 1996, India moved towards a dematerialized security system through depositories. Physical share certificates gradually gave way to electronic holdings of the securities, which we call it as dematerialization. The small word you must have heard of is a demat account, which is an electronic or digital account. From 1996 to 1997 onwards, NSDL and CDSL, they helped build India's modern dematerialized security infrastructure demat account system. Now 2000s, electronic trading and clearing became increasingly dominant. 2010s, India expanded electronic KYCs. Online trading and digital settlement infrastructure became massive in India. And 2020, the RBI introduced the fully accessible route, allowing the FPI's unrestricted access subject to conditions to specified government securities. And now it is 2026, SEBI is exploring whether the underlying market or the market infrastructure itself can move towards a blockchain-based tokenization. So this is not a sudden revolution. It is the next stage in a decade-long process, from paper securities to demat accounts, from demat accounts to everything electronic, and then to increasingly programmable securities. So there are potentially 5 major advantages of what tokenization can change. Number 1, faster settlement. If securities and money can move simultaneously on a shared infrastructure, settlements could become faster. The potential for real-time or near-time settlement in the tokenized environment. But remember, potential does not mean guaranteed. A pilot exists precisely to test whether these benefits will work in practice or not, but that is the intended benefit. Second is the less reconciliation. Now today, multiple institutions maintain records. Now that creates possibilities of mismatches, delays, manual reconciliation, and operational costs as well. A shared ledger could potentially reduce some of these frictions, which is why the second benefit. Now coming to the third benefit, which is programmability. Imagine a bond that automatically calculates a coupon, identifies eligible holders, and triggers payment. No touch needed. That's the idea of a programmable finance. The asset isn't merely digital. Parts of its life cycle can potentially become automated. So everything becoming automated or programmable. That's the third benefit. The fourth benefit is fractionalization. Now, tokenization can potentially divide an asset into smaller digital units. That raises an intriguing possibility. Could ordinary investors eventually gain easier access to securities than traditionally required large investments? Potentially, but don't confuse technical fractionalization with regulatory permission. SEBI would still need to determine who can invest, minimum ticket sizes, distribution rules, disclosure requirements, and investor protections. But still, that's a potential benefit. Fractionalization. The number 5th is transparency. See, a distributed ledger can create a tamper-resistant record of transactions which cannot be tampered. That can potentially make ownership history and transaction records very easy to verify. But again, blockchain transparency doesn't automatically mean economic transparency. If the information entered into the system is actually wrong, in the first part itself, the blockchain can faithfully preserve the wrong information, right? So basically, technology cannot replace governance. Governance needs to be corrected from the first hand itself. Now, let us destroy the hype. Because blockchain has a tendency to be presented as a magical solution, but it isn't, which is why there would be several problems as well. And problem number 1 would be liquidity. See, please understand, tokenizing an illiquid bond doesn't automatically create buyers. You can create the world's most sophisticated digital bond, but if nobody wants to buy it, it will remain illiquid. So technology cannot reduce transaction friction. It cannot manufacture investor demand. It can just make it simpler or easy. That's all. Now, there's a problem number 2. Interoperability. So India is already having SEBI, it's already having RBI, NSDL, CDSL. There are a lot of clearing corporations, banks are there, custodians are there, exchanges are there, intermediaries are there. How does a new blockchain system communicate with all of them? That's the interoperability problem. And until that is solved, tokenization may simply create another layer rather than removing the older layers. And then there's the problem number 3, which is legal ownership. Suppose a token says you own this bond. What happens if the blockchain says you own it, but another database says someone else does? Which record has legal supremacy? What happens during a dispute? Who is liable? These are not coding questions, these are legal questions. And India's tokenization securities framework is still developing. So legal framework also needs to develop with it, but right now it's potentially a challenge. Now problem number 4 of cybersecurity, which is a huge problem for India. So the irony is very obvious. You digitize the system to make it more secure, and suddenly cybersecurity becomes even more important. SEBI has also flagged long-term cryptographic concerns, including the possibility that sufficiently powerful quantum computers could undermine current cryptographic systems. So the technology designed to create trust must itself be trusted first. Now let's connect this to the other major announcement also made. On 20th of August 2026, SEBI allowed the foreign portfolio investors FPI to submit digitally signed powers of attorney to their own custodians, Previously, depending on the applicable circumstances, documentation could involve notarization or consularization. The new framework removes those requirements for the digitally signed POA accepted under the new process. So what is a power of attorney? It's simply a legal authorization, that's all. And foreign portfolio investor can authorize its custodian to perform specified activities on their behalf. Now imagine you are an investment fund sitting in Singapore, London, New York, Tokyo, wherever, and you want to invest in India. Every additional physical document requirement creates time, creates cost, creates friction and uncertainty. Digital documentation reduces that friction to a great level. And that matters because India doesn't just want domestic investors, it wants global capital as well. And this is where the second change related to the foreign portfolio investors matter. See, please understand, bond tokenization, digital FPI onboarding or online bond platforms, fixed income channel partners, credit risk disclosure, municipal bonds, international investment. These are not isolated reforms. They point towards a larger ambition of India to build a more deeper, more digitally and internationally accessible Indian capital market. And this opportunity is enormous. So look at the numbers. SEBI data shows outstanding corporate bonds of roughly 60.65 lakh crores as of July 2026. Meanwhile, transfer of corporate bonds recorded through NSDL and CDSL totaled approximately 13.47 lakh crores in the first 4 months of 2026 to 2027. That is not a niche market, it's already a massive financial ecosystem. The question is whether India can make that ecosystem more deeper, more cheaper, more faster and more accessible or not. So answering the final question now, will blockchain revolutionize India's bond market? Maybe, but the honest answer is we don't know yet. And that's precisely why SEBI is conducting a pilot program first. The pilot can answer questions that theory cannot. Now, can the system scale? Can it integrate with existing infrastructure? Can a regulator supervise it? Can investors trust it? Can it reduce costs? Can settlement become genuinely more efficient? Can it improve transparency without creating new risks? And most importantly, does it actually make the bond market better? If the answer is yes, India could gradually move from merely digitizing securities to making securities programmable as well. And that is a much bigger transformation. See, for years, India's financial revolution has been associated with UPI, digital payments, demat accounts, online trading, mutual funds, and the retail participation in equities. But the next major transformation may happen somewhere much less glamorous, which is the bond market. Because behind every bond is something fundamental. which is capital. Capital which is for infrastructure, capital which is for businesses, for housing, for innovation, for India's growth. And if India can build a bond market where capital can move faster, it can move more transparently with a lower transaction friction and across a broader investor base, then the impact could extend beyond the financial markets. And that's why SEBI's bond tokenization pilot matters a lot. But we should not fall into the trap of thinking blockchain is equal to revolution. The real revolution will only happen if technology solves actual economic problems, if it reduces friction, if it improves settlement, if it makes ownership easier to verify, and if it expands access, and if it helps channel more long-term savings into productive investments. Because ultimately, India doesn't need a blockchain bond market simply because blockchain is fashionable. India needs a better bond market. And if tokenization can help build one, then the small SEBI pilot could become the beginning of something much bigger, which is a shift from India's financial markets being merely digital to becoming increasingly programmable. And that could fundamentally change how money moves through the Indian economy. I hope you gained a new perspective from this session. All the very best and have a beautiful day. Do let me know your comments and your questions in the comments section. I'll be very happy to read them. All the very best and have a beautiful day. Thank you.